Hey everyone, this is Hunter Satterfield, one of the partners at Kane Waters and Associates, as well as the Chief Investment Officer and a member of our investment committee. As always, today I am joined by my fellow partner, Brian Bortz, who heads up our investment committee, and Brad Sanders, the Managing Director of Tectonic Advisors. This is your October market update. For the month of October, the S&P 500 was down 2.1%. Global stocks were down 3.3%. Domestic bonds were down 1.6%, and global bonds were down 1.2%. So a lot of negative outcomes for the month. As well, for the year now, the S&P 500 finds itself on an equal weighted basis down 2.5%, meaning if you give equal weighting to all the companies, they're down 2.5% in aggregate. The cap weighted index, which is the index that many of our clients are using, is actually up 10.7. So we've talked both on this recording and also on our podcast about how much those large seven stocks, they're calling them the Magnificent Seven, lend towards the overall weight. And through the end of October now, we find ourselves in a situation where all of the return of the market weighted S&P 500 is now coming from those large seven companies. So and I think that's going to tell a little bit about what happened in October, as those companies did have, some negative outcomes for the month. So, Brad, I'd like to come over to you. NASDAQ was down almost 3% for October. We see these returns as well. I talked a little bit about the Magnificent Seven. So what kind of happened both in the equity markets and then also in the fixed income markets, as we saw the 10-year yield sort of bounce all over the place? What kind of happened in October to create these two things?
Really think it's at the end of the day, it's an earnings story. You've had the better part of the market, as you mentioned, with the equal weight pricing in some economic slowness, or at least some sort of slowness to earnings over the course of the year. And you really had those seven stocks, or in general, mega cap technology, that have kind of been dragging the market along. This typically happens towards the end of big secular cycles. And I really, what you're seeing now is we're now year over year, the third quarter from when rates had really started accelerating last year. Rate hikes take about 12 to 18 months to work their way into the economy and to start affecting businesses. And we're about 18 months out from rates going from 0 to 5%. And the bogey changes on when you're dealing with a growth company. When you have 0% rates and you have a high growth company, any kind of top line growth is probably going to be rewarded with stocks price appreciation. When you have 5% interest rates, you have to have much higher growth in order to get the same sort of stock movement and to command the same sort of multiples. And what I think we're seeing from these companies is they're showing growth, but it's growth that's subpar compared with 3 to 4 years ago. And market participants are like, I'm not going to pay the same multiple unless I'm getting that kind of growth. And that growth's just not going to be as easily achieved with rates where they are and with the economic backdrop we have. So I think you're just starting to see maybe some market participants start to rethink a little bit about what they're doing with how they're concentrated. And I think that's going to benefit portfolios that are out there value hunting now, buying into sectors that are underowned. We've seen little snippets of that the day after Google's earnings, when that stock was getting hammered. Mid caps and small caps, active managers were up that day. I think that's a little glimpse of like maybe where that capital waterfall is going to go when it all happens in earnest. And this may take a while, but Apple has earnings tomorrow, and if Apple has a subpar quarter, it could speed everything up because that's kind of the bellwether. The bond market's tremendously volatile, but I think the two important takeaways are there seems to be a lid on it around 5%. We touched it. I think we got to 5.02 one morning, and it retreated badly. Anytime we get up into the 4.9s, it backs up dramatically like it did yesterday, then to today. I think that's a sign. That's a sign of the financial system telling you the cap on the 10-year is 5%. That's what the economy can handle. And by the fact that we're there, it means that the Fed's going to be more emboldened to keep policy where it is, not hike rates anymore, and let kind of the higher interest rates continue to press down on the economy and to slow things down in order to keep inflation going the right direction. And also, I think what's very interesting about the bond market is that credit spreads have barely moved. So when you have some sort of financial crisis or banking crisis, you have interest rates doing their own thing, but credit spreads are where you see the stress. That's the difference between like a corporate bond and a commiserate bond, a treasury of the same maturity. So a 5-year corporate and a 5-year treasury, if it's 3% and the corporate's paying 4, the credit spread's 1. And when you have stress, those credit spreads tend to expand, meaning if I'm going to take any risk outside of owning the treasury, you're going to have to pay me a lot more to do so. And those haven't moved. So all of the bond market losses have been duration driven, interest rates driven, which makes me very comfortable that when the Fed finally does change their language, we think middle part of next year and starts to ease, you're going to get a pretty big snapback in the bond market because the credit part has been behaving. So I think that should give clients that maybe are looking at their bond portfolios and having a little bit of reverse FOMO on those, that this too shall pass, and you're going to get a pretty big slug of that back the moment rates do ease.
Yeah, that's awesome. And I actually want to come back to you for just a quick comment on the Fed, who had a meeting today. But before we do that, Brian, I want to come over to you. We're getting questions from a lot of clients really surrounding two things, and maybe you could just talk very quickly on both of them. The first is obviously all of the global conflicts that are occurring, overseas. Talk a little bit about, kind of what the implications are of those global conflicts if they continue or worsen on our markets and on investing. The second is really on the banking system and whether the banking system, we had failures earlier this year, but is the banking system strong, or are we dealing with another potential, banking crisis if we've seen in prior years? You want to cover both of those real quick?
Sure. Thanks, Hunter. Yeah. The calls that I'm getting right now from clients are exactly on those two things. One, the concern of the current war that's going on in the Middle East, and whether or not that spreads to more of a regional or, in fact, more of a global concern as far as war is concerned. I think that there's always a possibility, of course, that either of those could happen. And countries are deploying, assets there as we speak. But the fact is that it's way too early to determine whether or not that's even a realistic outcome. There are times that war is actually a strengthening factor for some economies, and there are times that war actually creates a lot of uncertainty, and markets hate uncertainty. So right now, there's really no answer, and I think as it relates to the war, that there's a lot of volatility, and that's going to continue. If you look at the banking issue, I think that's more of a non-story. No, I do not believe that we're in a banking crisis, and I think Brad could add to that if he wanted to, and I think he has in past discussions that we've had on here. But we've had a couple of regional banks that failed, but this is not a banking crisis. This is not a situation like in 2008 where you no longer have a Bear Stearns, or you no longer have a Lehman Brothers. You no longer have Merrill Lynch. I know Merrill Lynch still exists, but it's owned by Bank of America now. So we don't have a situation like that going right now. Our banking structure is strong. The capital structure of banks are strong. Earnings disappointed, but the banks themselves are strong. So, I agree with one of the comments that Brad just made, that when the Fed decides to start easing rates and lowering rates, I think that first move, world according to Brian, is going to be there's a quarter point move out there at some point next year. And that very first quarter point move, I think the market's going to gleefully overreact to the thought that, hey, this thing's over. And that's kind of the message that I've been talking to my clients. Just be patient. We're going to ride out the bond thing, and we're going to get a lot of the bond losses that happened last year back just by being patient. And now is actually a great time that we're buying some low volatility fixed income, and we're not overpaying for earnings, like Brad said. So I feel really optimistic about where we are coming out of the economic cycle we just had.
Yeah, that's great. And as we timestamp ourselves today here, November 1st, as we're recording in the afternoon, Brad, I just want to come back to you very quickly. The Fed did speak today, held their pause in check. You want to talk a little bit about, obviously that's consistent with what, we have been saying. But you want to talk a little bit about what the Fed said and what we think it means, through the end of the year?
Yeah, they basically, in short, and I haven't had time to digest the entirety of the report yet, but it was that rates, they're on pause still, that they have no plans to cut anytime soon. So staying hawkish, higher for longer, same policy that they've had. There was some interesting language that seemed like they were maybe taking a little bit of jab on the fiscal spend and the government spending. The Fed's doing everything in their power from a financial condition standpoint to lower inflation, and they've got all the arrows kind of pointing the right way. But you have the other side where you have all of this spending coming out of the government that is kind of papering over a lot of the work the Fed's doing. And they can't control that, right? So I want to read the whole statement because I was watching Powell, and it was kind of interesting. He was kind of maybe taking some veiled shots at maybe Janet Yellen and some of that stuff about, hey, you could help us out by not, spending an extra 300 billion every other week and stuff like that. But other than that, really, from a Fed standpoint, higher for longer, and they didn't really change. We don't expect them to change until the second quarter of next year, unless the economy necessitates that by falling off a cliff. And to Brian's point, this isn't a banking crisis at all. This is disintermediation of a bank's balance sheet. All the prior banking crises had to do with assets going boof and going away, and the bank's balance sheet overnight becoming insolvent. That's not what this is. It's its own separate issue. It's not great, but it's not a banking crisis at all.
Well, yeah, thanks, guys. And, for you listeners and viewers, we have recorded a podcast series specifically around the history of the banking system and also the Federal Reserve. So stay tuned for those on the Accumulating Wealth podcast. Listen in. Those are really interesting. Brad is one of our guests on those. We hope, obviously, as we go into November, that you have a wonderful Thanksgiving, and we will be back in front of you at the end of November as we head into the end of the year. Thank you so much.